Good evening and welcome to Money Matters, your deep dive into the forces shaping Australia's financial landscape. Tonight, we peel back the layers of government support, from energy credits to Centrelink indexation and state-specific grants, to understand how these lifelines are truly impacting the household budgets of working parents and suburban families across our nation. In an increasingly volatile global environment, where headlines range from tragic geopolitical events to domestic policy debates, the conversation around financial stability for the average Australian has never been more critical. The world outside Australia's borders continues to present formidable challenges. Just this week, the devastating news of a second Russian attack on Kyiv in less than a week, claiming 14 lives, serves as a stark reminder of the global instability that ripples through supply chains and commodity markets, directly influencing the prices we pay at the petrol pump and the grocery store. Closer to home, community anxieties are also surfacing, as evidenced by the disgusting anti-Semitic graffiti recently discovered on a historic Anzac landmark along Western Australia's south coast. These events, while disparate, contribute to an overarching atmosphere that can influence consumer confidence and the perceived resilience of our society. Ben, let's start with the hard numbers. What's the current pulse of the Australian economy?
Adam, the Australian economic narrative is one of persistent inflationary pressures, albeit with some signs of moderation. We're seeing the consumer price index, while decelerating from its peaks, still hovering at levels that significantly erode purchasing power. The Reserve Bank of Australia has implemented a series of interest rate adjustments to manage this, leading to a noticeable shift in borrowing costs for households. Household savings ratios have also trended downwards from their pandemic-era highs, indicating families are drawing more on reserves to meet daily expenses. The unemployment rate remains historically low, which is a positive, but real wage growth has struggled to keep pace with the cost of living.
Ben's numbers are our everyday reality. Take the Miller family from Pakenham, Victoria, for instance. Both parents work full-time. One's a nurse, the other an electrician. They have 2 kids, aged 8 and 5, in public school. Their mortgage repayment on a modest 3-bedroom home, which was $2,200 a month 2 years ago, has now climbed to $3,200. That's an extra $1,000 every single month. When the recent federal energy credit came through, let's say it was $300 for the quarter, it felt like a small, albeit temporary, reprieve. For the Millers, that $300 directly offset almost half of 1 month's increased electricity bill, which had surged from $450 to nearly $650 per quarter. It didn't solve the core problem of rising costs, but it meant they didn't have to choose between fresh fruit for the kids or putting petrol in the car to get to work for a short period. They immediately put that $300 towards the overdue bill, preventing a late fee, and for a moment, they felt a little less squeezed.
From an institutional perspective, the RBA's mandate is price stability and full employment, operating within a global economy that is undeniably turbulent. The ongoing geopolitical tensions, exemplified by the continued conflict in Ukraine, inject significant uncertainty into global energy markets and supply chains. This directly impacts Australia's import costs and, subsequently, domestic inflation. The government's fiscal responses, including various rebates and targeted payments, are designed to cushion the impact on households without excessively stimulating aggregate demand, which could exacerbate inflationary pressures. It's a delicate balancing act to provide relief while not undermining the RBA's monetary policy objectives.
A delicate balance indeed, Diana. It seems we're navigating a complex interplay of global shocks, domestic policy, and the very real daily struggles of Australian families. Beyond the immediate headlines, what are the deeper structural forces at play, Ben, that are driving these costs and necessitating government intervention?
The why behind our current economic situation is multifaceted, Adam. Globally, we've observed a systemic imbalance in supply chains post-pandemic, exacerbated by geopolitical events like the conflict in Eastern Europe. This has led to elevated commodity prices, particularly in energy, which flows through to almost every sector of our economy, from manufacturing to transport. Domestically, our housing market, an important asset class, has seen rapid expansion over the past decade, driven by low interest rates and population growth. Now, with higher interest rates, many households are facing significantly increased mortgage servicing costs. Historically, governments have used fiscal levers, subsidies, tax breaks, and direct payments to manage economic cycles and support vulnerable populations. The current suite of rebates is a direct response to this confluence of domestic and international pressures on household budgets.
From a policy standpoint, the government's approach is often a blend of immediate relief and longer-term structural adjustments. Centrelink indexation, for example, is a built-in mechanism designed to ensure that social welfare payments keep pace with the cost of living, typically adjusted twice a year based on CPI and average weekly earnings. This is a foundational element to prevent a sharp decline in living standards for those most reliant on government support. State grants, on the other hand, can be more targeted, addressing specific regional needs or particular sectors, such as education. The recent findings by a parliamentary committee that the ACT's school language education plan is not fit for purpose highlights a different kind of structural challenge. While not a direct financial handout, a robust, centralized education plan, particularly for ATAR-level languages, represents a significant investment in human capital. A fling plan implies potential future costs for families seeking private tuition or for the economy missing out on skilled multilingual workers, impacting long-term productivity and competitiveness. So, while energy rebates offer immediate relief, discussions around educational policy reveal a more intricate, long-term impact on household financial planning and future prospects.
Diana's point about education costs is very real for us on the ground. Consider the Wong family in Chatswood, Sydney. They earn a decent income, but with 2 kids in high school, they're constantly weighing costs. Their eldest wants to study Japanese for the HSC. If the public school system isn't adequately supporting advanced language education, as the ACT report suggests, might be a broader issue, the Wongs face a choice. They could pay $80 an hour for private tutoring, twice a week, adding $640 a month to their budget. Over a year, that's $70,680, a sum that could easily cover a significant portion of their family's health insurance premium, or a term of their younger child's extracurricular activities. This isn't a direct handout they're missing, but it's an uncovered cost created by a gap in public provision. Similarly, for a single parent in Geelong receiving a Centrelink parenting payment, the indexation increases, while welcome, often feel like chasing a moving target. If their payment increases by $30 a fortnight, but grocery prices for staples like milk and bread have risen by $5 each week, and their gas bill went up by $15 a month, that GN is quickly eroded. The financial pressure rems intense, illustrating how underlying structural drivers often outpace the relief efforts.
It highlights the complexity of connecting policy intent with real-world impact. When we return, we'll delve deeper into the divergence between institutional MS and consumer realities. Welcome back. The gap between the broad strokes of macroeconomic policy and the granular details of household budgets can often feel immense. Diana, how does the RBA view this divergence, especially given their actions to manage inflation?
The RBA is acutely aware of the lag effect of monetary policy, Adam. Interest rate adjustments don't immediately translate into changes in inflation or household spending. There's a delay, typically 6 to 18 months, before the full impact is felt. Our policy decisions are made with a forward-looking perspective, to steer the economy towards sustainable inflation targets and full employment over the medium term, typically 2 to 3 years. We aim to prevent a prolonged period of rapid price increases that could significantly diminish the value of savings and investment in asset classes like fixed income and equities. However, we acknowledge that in the short term, these adjustments create considerable pressure for mortgage holders and those managing debt. Government fiscal policy, with its more immediate handouts and rebates, acts as a complementary measure, providing direct, short-term relief where monetary policy has a broader, slower impact.
And the data certainly shows that divergence, Diana. While the RBA works to cool demand, wage growth data indicates it's still tarling inflation for most Australians. This means, in real terms, many working families are seeing their purchasing power diminish, despite a strong jobs market. Housing affordability as an asset class also presents a stark picture. Property values, while experiencing a market correction in some areas, remain historically high, making entry difficult for new buyers. For existing mortgage holders, the impact of rising rates is substantial. Take a typical mortgage of $600,000 at a variable rate. If the interest rate rises by, say, 3 percentage points over a year and a half, the monthly repayment could jump from approximately $12,800 to over $4,000. That additional $200 a month comes directly out of discretionary spending or forces a reevaluation of essential budgets.
That $200 Ben just mentioned? That's not a theoretical number for the Davies family in Ipswich, Queensland. Mark and Sarah both work in administration, earning a combined income of around $130,000 a year. They have 2 young children in childcare, which costs them $2,000 a month after the government's childcare subsidy. Their mortgage repayment went up by $1,950 a month in just 18 months. That's the equivalent of 6 weeks of their entire grocery bill for a family of 4, which is currently around $180–200 a week. Or it's what they used to save for their children's future education fund, or to put into their superannuation, both essential asset classes for long-term security. Now that $150 is gone, so when they get a $250 state government back-to-school voucher for each child, that $500 feels enormous, but it barely scratches the surface of the new higher costs. That $500 might cover the school uniforms and half the required textbooks, but it doesn't touch the increased cost of petrol to get the kids to school, which adds $30–40 more a week to their budget. These small grants are appreciated, but they highlight the deep financial hole families are trying to climb out of, not necessarily filling it. It creates a feeling that while the institutions are trying, the ground beneath us is shifting too quickly.
Chloe, your examples vividly illustrate the pressure points. It seems the intended relief from government support is often absorbed by the broader inflationary environment. The challenge for policymakers, then, is not just providing support, but ensuring that support effectively translates into tangible improvements in household financial health. As we look ahead, what does the future hold for Australian families grappling with these economic forces? Ben, your macro projections, please.
Forward projections suggest continued vigilance will be necessary, Adam. We anticipate inflation will continue its gradual deceleration, but it may take longer to return to the RBA's target band of 2 to 3% than initially hoped, particularly with persistent global supply concerns linked to geopolitical tensions. The labor market, while strong, may experience some normalization, with a slight uptick in the unemployment rate as economic growth moderates. For asset classes, we're likely to see a continued reevaluation. Fixed income investments, which have struggled during periods of rapid price increases, may become more attractive as inflation expectations stabilize. Equities, particularly those companies with strong balance sheets and pricing power, could offer resilience, though overall market volatility might persist. The housing market may experience further market corrections in certain segments, but a sharp decline across the board appears less likely, given underlying demand and population growth. The key will be how households adapt their spending and saving patterns in this evolving environment.
From an institutional perspective, the RBA will remain data-dependent, assessing both domestic economic indicators and global developments. Our objective remains to foster a stable economic environment, but we must acknowledge the persistent external risks, such as the ongoing conflict in Ukraine, which continue to inject uncertainty into global energy and food supply CHNs. Governments will likely continue to walk a tightrope, balancing the need for fiscal prudence with targeted support for households and critical sectors. This includes ongoing evaluation of the effectiveness of initiatives like energy credits and the indexation of social payments. The discussions around public services, such as the ACT's language education plan, will also continue to be crucial, as these represent long-term investments in the nation's human capital and indirectly affect family budgets through opportunities or uncovered costs.
For families like mine and the many I speak to, the forward projection is really about resilience and adaptation. My neighbor, a mom of 3, recently told me she's had to completely reevaluate her superannuation contributions, an important long-term asset class. She used to contribute an extra 2% above the mandatory amount. Now, to cover rising expenses, she's had to reduce it back to the minimum. That's a small individual decision, but across millions of Australians, it has significant implications for future financial security. We're looking for stability, for predictability. We budget meticulously, trying to find savings wherever possible. Meal planning to cut grocery waste, carpooling to save on petrol. The hope is that the government's support, combined with the RBA's efforts, will eventually create an environment where those small, hard-won savings can actually contribute to building some financial resilience, rather than just covering the next urgent bill. It's about being able to save for a deposit on a first home for our kids, or genuinely grow our super, rather than just treading water.
Chloe, your perspective brings into sharp focus the human dimension of these complex economic forces. From the global tremors affecting our fuel prices to local policy debates influencing our children's education, and even the societal cohesion reflected in community landmarks, every factor contributes to the intricate web of financial pressure on Australian households. The journey ahead for working parents and suburban families will undoubtedly demand continued adaptability. And for policymakers, the challenge rests to ensure that government support not only provides immediate relief, but also helps lay the groundwork for long-term economic stability and opportunity for all Australians. Thank you for joining us on Money Matters. Good night.